A new kind of loan, understanding private credit. What is private credit? Think of it this way. It is a loan that doesn't come from a big familiar bank. Instead, it comes from a private group of investors. Private credit is money that these private investors lend directly to companies. Sometimes they lend it to people. The key fact is this: these lenders are not traditional banks. They are specialized funds. They are wealthy individuals. They are other private organizations. They operate outside the bright lights of the public markets. They are a significant and growing force in our economy. One you may not see, but one that is there. Imagine you own a small local business. Maybe it's a coffee shop. Maybe it's a small factory. You need money to buy new equipment to expand your operations. You might go to your local bank, but they turn you down. Their rules are too strict. Your business is too new. The mechanics of private credit are surprisingly straightforward. It follows a clear and logical path. It all begins when someone needs money. This borrower could be a medium-sized company trying to acquire a competitor. It could be a real estate developer looking to start construction on a new apartment building. The need is the starting point. These borrowers, for various reasons, either cannot go to a traditional bank, or they do not want to go to a traditional bank. So they look for an alternative. They look for a lender who is willing to listen, and a lender who is able to act quickly. This is where the private lender steps in. This lender is not a bank branch on a street corner. It is often a specialized fund. Think of it as a pool of money collected from various investors. These investors want to earn a return on their cash. The fund's managers are experts at finding lending opportunities. They evaluate the borrower's request. They assess the risk. They decide if the potential reward is worth that risk. If they like what they see, they make an offer to lend the money. This process can happen much faster than at a large, bureaucratic bank. Once the offer is on the table, the two sides negotiate the terms. This is the heart of the deal. They agree on the interest rate. They agree on the loan's term. They agree on any rules or conditions, known as covenants. So, who are these lenders? Where does all this money come from? The lenders in the private credit market are a diverse group. They are not the household bank names you see advertised on television. They are typically large, sophisticated financial players. A major category is the dedicated private debt fund. These are firms created specifically to lend money in this way. Giants in the world of finance: Blackstone, Apollo, KKR. They raise capital from other big investors and then deploy it as loans. Insurance companies are also significant lenders in this space. Think about it. An insurance company collects premiums from its customers every month. It needs to invest that massive pool of cash so it can grow and be there to pay out claims in the future. Private credit loans offer them a way to earn a steady, predictable income stream. The returns are often higher than what they could get from ultra-safe government bonds. For an insurer with a long-term view, these private loans can be a very attractive investment. They are willing to trade immediate access to their cash for a better long-term payout. Another key group of investors is pension funds. These are the funds that manage the retirement savings for millions of teachers, firefighters, and other workers. Like insurance companies, pension funds have a very long time horizon. They need to generate consistent growth over decades to meet their future obligations to retirees. They see private credit as a way to boost their overall returns. By allocating a portion of their portfolio to these private loans, they hope to earn more than they would in public markets, helping to ensure the health of the pension plan for years to come. Finally, very wealthy individuals, family offices. These investors have substantial capital and are often looking for unique opportunities that are not available to the general public. They can afford to hire experts to analyze these complex deals. They are also able to take on more risk in pursuit of higher returns. Their involvement adds another layer of capital to the market. Together, all these lenders have channeled trillions of dollars into private credit, seeking better returns and more flexibility than traditional investments can offer. They are the engine powering this boom. On the other side of the transaction, we find the borrowers, who are the companies and individuals turning to private credit. The range is broad, but a primary group is small and medium-sized businesses. These are the companies that form the backbone of the U.S. economy. They may not be large enough to issue public bonds. They might find the loan application process at a big bank to be too slow or rigid. For them, a private lender can be a lifeline. It provides the capital they need to hire new employees, open a new location, invest in technology to become more competitive. Even very large corporations sometimes turn to private credit. This might seem surprising. These companies often have strong relationships with big banks. However, speed and certainty can be critical. Imagine a large company wants to buy another company in a multi-billion-dollar deal. They need to have the financing lined up immediately to make their offer credible. A private credit fund can often commit to a very large loan faster than a syndicate of banks. This speed and decisiveness can be the difference between winning and losing a major strategic deal. The higher interest rate is a price they are willing to pay for that advantage. Real estate developers are also major borrowers in the private credit market. Building a new office tower, a shopping center, a large apartment complex requires a huge amount of upfront capital. Banks have become more cautious about lending for construction projects, especially after past downturns. Private lenders have stepped in to fill this void. They provide the short-term construction loans that get these projects off the ground. Without this source of funding, many new developments you see rising in cities across the country might never have been built. They are a critical source of financing for the real estate industry. Less commonly, but still significantly, some individuals use forms of private credit. This can range from a high net worth individual taking out a large, bespoke loan against their assets to an everyday consumer using a payday alternative loan from a non-bank lender. For consumers, these options often appear when traditional credit is not available. While they provide access to cash, they frequently come with much higher costs and fewer consumer protections than a standard bank loan. This part of the market highlights the dual nature of private credit. It can be a flexible tool for business, but a costly option for individuals in a tight spot. The rapid expansion of private credit is not an accident. It is a direct response to major shifts in the financial world. The most important catalyst was the 2008 global financial crisis. In the aftermath, lawmakers and regulators imposed much stricter rules on banks. Dodd-Frank, United States; Basel III, International. Those rules required banks to hold more capital in reserve. That made banks less able to make riskier loans. That pullback created a vacuum in lending. A new group of lenders stepped forward to fill the gap. At the same time, central banks kept interest rates near zero for over a decade. Rates near zero helped borrowers, but it hurt investors like pension funds and insurance companies. They could no longer get returns from safe government bonds. Earning 1% was not enough. Earning 2% was not enough. So investors were forced to look for alternatives. They began a massive search for yield. Private credit became the perfect solution. Companies couldn't get bank loans. Large investors needed higher-yielding assets. Private credit funds acted as the intermediary. They connected investors' search for yield to companies' need for capital. That symbiotic relationship fueled explosive growth. The market started feeding on its own success. What was once niche became a pillar of corporate finance. The market has more than tripled in size over the last decade. It now stands at over $1.7 trillion globally. Experts predict it will continue to grow. See 2008-2026 growth line. This represents a fundamental change in how money flows through the economy. Lending moved from the highly regulated public world of banking into the less transparent private world of investment funds. This change brings opportunities and raises new questions about risk. Like any financial tool, private credit is a double-edged sword. It offers significant rewards, but it also carries significant risks. For borrowers, the primary reward is access to capital. It can be the fuel for growth that banks are unwilling to provide. The flexibility of private lenders can be a major advantage. The speed of private lenders can be a major advantage, allowing businesses to seize opportunities quickly. But this access comes at a price. Interest rates on private loans are almost always higher than on bank loans. This makes the debt more expensive to service, which can strain a company's finances, especially if its business slows down. The terms of these loans can also be tougher for borrowers. Because private lenders are taking on more risk, they often demand more control and they often demand tighter restrictions. A loan agreement might include strict rules about the company's financial performance. If the borrower's profits dip below a certain level, it could trigger a default, even if they are still making their payments. This gives the lender a great deal of power. Furthermore, because these are private deals, there is generally less regulatory oversight and fewer standardized protections for borrowers compared to the world of traditional banking. A deal gone wrong can be harsh and swift. For the lenders and their investors, the primary reward is the high return. Those higher interest rates paid by borrowers translate into higher income for the pension funds and for insurance companies that invested in the loan, but this comes with its own set of risks. The biggest is credit risk, or the risk that the borrower will fail to pay back the loan, because private lenders often finance less established companies or more highly indebted companies. The chance of default is inherently higher. If a borrower goes bankrupt, the lender could lose some or all of their investment. This is the fundamental gamble they are taking. Another major risk for investors is illiquidity. These loans are not like stocks that can be sold in a second on an exchange. They are private contracts meant to be held for years. If an investor suddenly needs their cash back, they can't simply sell the loan. This lack of liquidity means their money is tied up. This is fine when things are going well, but it can become a serious problem in a crisis. If the economy turns down and many borrowers start to struggle at once, lenders could face widespread losses with no easy way to get out of their positions. This is the scenario that keeps regulators up at night. You may never take out a multi-million-dollar private loan, but this market affects you in quiet, important ways. Think about the small businesses in your community, a local restaurant that expands, a small manufacturer that adds a second shift. These businesses create jobs. If they are using private credit to fund that growth, then the health of this market is directly linked to the health of your local job market. When private credit is flowing, it can be a powerful engine for job creation. If it dries up, those same businesses may struggle to grow or even survive, which could mean fewer jobs in your town. The housing market is another area where you can feel the impact. Developers use private credit to build new apartment buildings and housing developments. A steady flow of this financing can lead to more housing supply, which can help to keep rents and home prices in check. On the other hand, if these loans are made recklessly and projects fail, it can lead to stalled construction sites and financial losses that ripple through the local economy. The availability and cost of housing in your area can be influenced by these behind-the-scenes financial deals you never see. It is a hidden factor in one of life's biggest expenses. Even your retirement savings may be connected. If you have a pension plan through your job, its managers may be investing in private credit to boost returns. When these investments do well, it helps keep the pension fund healthy, securing your future retirement income. But if the funds that hold these private loans perform poorly, it could hurt the pension's value. This means that the success or failure of companies you have never heard of, funded by loans you did not know existed, could one day affect the size of your retirement check. Your financial future is indirectly tied to the performance of this market. Given these connections, it is wise to be aware. You do not need to be an expert, but you should be cautious and informed. First, always compare your options: banks, credit unions, private lenders. Second, read the fine print. The cost of a loan is more than just the interest rate. Understand the fees, the penalties, and the rules before you sign anything. Finally, focus on building your own financial safety. A strong credit score and an emergency fund give you more choices and better leverage. They are your best protection in an increasingly complex financial world.